Let's bring in Gilbert Garcia, managing partner, Garcia Hamilton Associates, and a CNBC contributor listening in. I probably should have kept Steve around for this because he knows more about it. But you get my point, Gilbert, which is that, and I don't want to throw stones politically, but there are some high-level politicians who come out and on Twitter or whatever who say, prices are coming down, inflation's coming down. Prices aren't coming down. The rate of increase is coming down. And the Fed's got to be looking at that and trying to figure out what to do. What would you do?
Sure. First, there's two different things. One is inflation means prices are rising. But remember, that means prices are rising. Deflation means prices are declining. So we are still in an inflationary environment, but the amount of inflation is rising at a slower pace. That's the key. So going back, what would I do? I think the Fed is making a terrible mistake. I think they should already stop raising rates, and they should give the economy a glide path to let all these big rate increases filter into the economy. We've raised rates in very big chunks in a very short period of time. And by focusing on labor and wages, those are more lagging indicators, and they should be looking at forward indicators, whether it's money supply, whether it's leading indicators. And if they did that, they would recognize they need to take their foot off the raising rate pedal.
I love the magic of TV. I said we probably should have kept Steve around. And guess what? He reappears on the giant monitor. It's like, pay no attention to the man behind the curtain. Steve, jump in on this, because there's a lot of people that are in Gilbert's camp, which is, would it kill him to wait a couple of meetings and just see how things shake out? Because if you kill inflation by destroying the economy, is that a win?
No, it's not. I don't think it's the intention of the Federal Reserve. You know, Gilbert can talk in ways that I don't necessarily talk as a reporter. I will point out that I have noted quite a bit in my reporting that the Federal Reserve has not taken account of the change in the data. We've had a series of really lousy data points. ISM services were terrible. ISM manufacturing was down. Yesterday's manufacturing report, yesterday's retail sales report, all should have made you, if you're a Fed official, sort of sit up a little bit taller in your chair and take a look around and say, maybe I don't have this exactly right. The Fed is not purposely trying to tank the economy, but it sees moderation in economic activity as a key way to bring down inflation. And what's been notable to me is the Fed has not taken account until this Brainerd speech. And that's why I think the Brainerd speech is important. It's the first one that says to me they're aware of the very things that Gilbert's talking about. What Brainerd does not do is take that extra step that Gilbert just did and said, that should change my monetary policy. And if you will, very quickly, Brian, take a look at the spread of officials and their 2023 rate forecasts. 17 of 19 are above 5%. Only 2 are below. So even if Brainerd is a dove, she's still among that group. She could only be in the 490 and higher for all of 2023 or for ending 2023. That's the doviest person that could be on the. I'm not saying that, sir. I don't know it. But if she is a dove, then all she is 490. So there's nobody on the Fed that is in Gilbert's camp here. And this idea that, hey, maybe we should be rethinking how far we go.
Gilbert, jump in.
Yeah. And the other thing, too, Steve, is I really think they're losing some of the basic fundamentals of focus on things like money supply growth. If you look at money supply growth, it is now growing at a negative rate, whether it's year over year, whether it's high frequency, 3 month over 3 month. And we haven't seen these sorts of numbers since really the Depression. And I really think they should be focusing on that and realizing that the correlation between money supply growth and about 12 months or so the economy is so tight and so high that they should realize we need to take our foot off the gas pedal now, stop raising rates. Because if they do, and I know we didn't use this term, but if they do wreck the economy, I'm just being alarmist here. If they do that, it'll take so long to recover if businesses go out of business and people lose jobs and people getting retrained. They need to be very, very careful, and they should stop raising rates now.